Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. Chris and Jason here. We appreciate it. Today we're going to be talking about how we limit our LTVs, both based on as-is value and after repair value. And so we're getting ready for our monthly training tomorrow for the Hard Money Mastermind. And I was thinking about a situation that happens a lot at RIA meetings and meetups and stuff like that. If you've ever chatted with another private lender, like, a solo lender who maybe lends out of their self-directed IRA or just does a couple deals with local investors with their own cash at a time, oftentimes you'll pick up in conversation that they don't do much in the way of due diligence. They'll use comps for valuation from the borrower, which is an obvious little conflict of interest there. Not much goes into the file at all in terms of like borrower's financials or anything else. Plus, you'll hear them say they'll fund 100% of the purchase price and the construction costs. And sometimes they'll even not hold the escrow and just give it to the borrower and just rely only on hope. So part of the reason why we want to hit this topic, and in general, why we started the Hard Money Mastermind, is to protect people from losing money by doing bad loans.
Yeah. And we didn't just make up the 65% loan to value. And I know that there's other lenders, and it's like, for competing purposes, we'll lend 70% or we'll lend 75%. Like, it's kind of non-negotiable. 65%, the reason that's kind of a hard number, and that's up to. Everything is up to. Most loans that we do are a lot less than 65% of the after repair value. That is up to. And the reason why is you need a 35% equity cushion if that deal starts going sideways. That's what's going to happen. There is plenty of deals that we have done where, it goes into default and things happen, right? Like we file foreclosure. We have to file for judgments. The borrower files bankruptcy. They contest our foreclosure. They stop making payments. We have to step in and cover legal fees or property taxes or insurance or whatever the case is. And you pretty much just scrape out if that's the case. You can eat up 35% equity very quick. Now, let me make a note related to that real quick that I think is important. Unfortunately, if you're in an area that has lower property values and and you're doing lower loan amounts because your median housing price neighborhoods are smaller, in essence, you could have a little bit more risk. And let me explain why. So there's a difference between percentage of equity and dollars of equity. So do the math on this. Let's say you do a loan and the after repair value is $100,000 and you do a loan up to 65% minus your construction costs. So when you're fully exposed and you have a $65,000 loan against a $100,000 piece of property, you have 35% in equity, right? 65% loan, 35% in equity, and you have $35,000 of equity dollars, right? Now let's look at the other side of it. You do a $300,000 loan and you do a 65% LTV deal. Well, your loan's $195 on 300, but in that case, you only have $105,000. Or I'm sorry, you have 100. Not only this is a good thing. You have $105,000 of equity. You're still at 35% equity cushion side by side on paper. Those numbers are the exact same percentage wise, but the difference is you have $105,000 of equity over here and $35,000 of equity over there. So significantly less risk on the higher dollar property.
Yeah, and the reality of this business, guys, is that we do lose deals because of the loan amounts we do. We could do more volume if we were willing to bend those rules of 65 LTV on ARV and 80% of purchase, but we're willing to lose some of that loan volume because we don't negotiate on risk. We don't play the game of let's do a ton of loans, a ton of units, and then take a loss on some of them and see where the bottom line shakes out. And some people end up doing it that way. I don't think they intend to do so, but it's more just a lack of experience and time in the market. And, the other part of that reality is that we've done, 3,000 or 4,000 loans over the past 17 years. So we've had the defaults. We've seen them. We've seen them on ARV properties. We've seen them on as-is properties. We constantly have defaults that we're managing. And that's why within the mastermind group and the inner circle, we bring this up a lot because people do feel the need to negotiate on risk and LTV in order to win deals. And look, we get it. We get it. You got to close loans. You got to have revenue. You have to have that to run a business. But at the same time, like, how far are you willing to go in your risk management? And, you know, like you hear say a lot, like it comes back to how many opportunities you have coming in the door. Because if you have enough leads coming in, you have a confidence to quote safe deals, right? Because if somebody doesn't accept your loan terms, so be it. You have another few quotes going out today.
Yeah, and every once in a while, I'll hear from borrowers ask this question, or other lenders that we've worked with inside the mastermind group ask this, be like, well, you know, normally I would charge, you know, 12.99 and 3 points. That's what we charge in our deals. But the borrower is willing to pay 5 points if I give them higher leverage. Well, guess what? Like, charging more is not like a bank where they believe they're reducing their risk by giving higher leverage. You could charge 3 points, 4 points, 5 points, 6 points, a higher interest rate. Your risk is still your risk, right? By you making an extra 2 points, you know, on a $100,000 loan call, you making an extra $2,000 to give them more leverage doesn't work, right? Like, you're not reducing your risk by charging more. You're reducing your risk by, in essence, reducing your leverage and reducing your exposure. You know, the 4 C's of underwriting that we talk all the time is collateral. That's the most important thing, right? Like, you need to make sure that if all else fails, and listen, good borrowers default sometimes. Shit happens, right? They end up being over levered.
True.
They have too many projects going on. You know, God forbid they get a serious injury. Like, some borrowers walk away. Like, you know who's not going to walk away from a project? A borrower that has a lot of skin in the deal, has a lot of equity in the deal, has a lot to lose. We've had deals that have gone sideways, and the borrowers had so much to lose that they walked away from potential profits on their deal, right? They were like, I'm not going to make any money on this deal, but they still had so much, they still had so much skin in the deal that they wanted to be able to recoup that. So it's an important way to do it. Like, I hate to say it, and we'll just be blunt. You can't give people 100% financing. It doesn't work. You can't give them 100% financing. It just doesn't work. Is there a time in the market that it could potentially work? Maybe, but that's not now. And even if a real estate investor is finding a really, really strong deal, and, you know, honestly, we have seen those over the last few months as the markets have softened a little bit. We've seen some really, really good deals. You still can't give them 100% financing. You got to be smart. You got to protect your investors' capital. You got to protect your own capital. That 35% equity cushion will disappear very, very quickly, because that's what this topic of this podcast is, right? It will disappear. If you've been in this business long enough and you've had your fair share of defaults, 35% equity, like whoever made that up 100 years ago, like, that's a real number. I mean, think about it. Real estate investors in general, they try to look for properties that they're buying at 65 cents on the dollar minus construction costs, right? To buy a really, really good opportunity, right? They want to have 35% equity cushion. Like, we stated this earlier, and I'll reiterate it. This is what happens if a borrower defaults or potentially walks away from a property. And the last point is going to be the biggest risk out of all of it, which is a humongous risk. So, you know, they're back on interest payments, right? You potentially have to step in and pay taxes. You potentially have to step in and pay insurance, potentially have to step in and pay legal fees. Now, if you're going to foreclose on a property, like, there's typically 2 options. You either get a small foreclosure mill that can fly and do quick foreclosures very, very quickly, and potentially, I shouldn't say very, very quickly. They do it and they're inexpensive, but you get what you pay for. Or you have a good powerhouse law firm that, you know, can power through these foreclosures, and they're going to be more expensive. But again, you get what you pay for. You don't have to micromanage them. They're going to do everything properly. They're going to put all the notices in place properly. You know, borrowers obviously can file bankruptcy, right? And then you got to go through that. They can test your foreclosure. If a borrower does not want you to foreclose and they want to fight you on it, you know, and it turns into a litigation, it can take a lot of time and a lot of money to do so. So all of these things kind of take into account. But the biggest risk that you have is when a borrower starts going sideways, that they don't continue to maintain the property, and there's deferred maintenance. Deferred maintenance can be awful. There's been situations in the past where a borrower will almost gets done renovating the property. They're 80% done, and potentially they walk away, they're out of money, whatever the case is, and the property sits there vacant, and that is the worst thing that could happen. The property sits there vacant, and you can't really do anything to protect it. Yeah, you can potentially go up there and board it up and put locks on it and stuff like that, but it's still there. You don't own the property at that point. And in essence, it could just start going in the wrong direction. Then you got to rehab everything. So there's risks. This isn't a risk-free business. We're not going to indicate that. So you want to do whatever you can to make this as risk-free as possible by lending to good borrowers that have real skin in the deal, and there's real equity in these properties.
Yeah, like you hear us say all the time, like the first mortgage lender, us, should have the lowest amount of risk in that deal, right? If you're doing 100% financing, you have all the risk. You're the only one with risk, besides maybe a few bucks out of pocket from the borrower. So yesterday we had our monthly default meeting, and I'll tell you how those go. So we get on a Zoom call with our business partners and loan originators from different markets, and we take a look at the portfolio one by one, like originator by originator, and we see at first like who's a little bit behind, right? Like who's one payment behind, maybe two payments behind. And at that point in time, we have a decision to make if we're going to start the default process, change it to the default rate, add an attorney fee, have them send out a demand letter. And we also, during that conversation, talk about what's the condition of this property. And that has a lot to do with it. Like if they ran short on money and the property's complete and hitting the market, it's fine. Like that's not a default situation. But the ones you really have to worry about are construction jobs that are not complete. And that's common. I spoke to a guy this morning, a borrower who's in default now, that we discussed his situation in yesterday's meeting. And in essence, like he did during the 12-month loan term, he made his payments and he only did one construction draw worth of work. Like he did demo and like some other minor things, right? And then after that, he's just not doing the work so that we can reimburse him so we can finish the project. He's just not going to do it. He wasn't doing it 9 months ago. He's not going to start performing now. It's just not what happens. And so I had a frank conversation with him about like, look, your only way out at this point, your smartest way out, because we're going to have to start foreclosure here soon. Put that property on the market, sell it as is, get as much as you can, as the market will bear, and get as much money back as you can. That's it. Like that's the only thing to do at this point if you can't finish a job. And so we as lenders, we also have to be in a good position when that happens, because it does. Like there's situations like this we discuss every month, and we underwrite carefully, and we try to lend to the people who we know can perform. Most of the time, the vast majority of the time they do. But every month there are people who are not completing their construction. If you do enough loans, you'll realize that too. Might not happen in year 1 or year 2, but you'll see it. People go sideways on a construction project, and who knows what they have behind the scenes, like other money obligations, maybe they have other projects going on, whatever it might be. Like who knows? Incomplete jobs happen all the time. So your job as an underwriter is to make sure that if that happens, you're still in a safe position with your exposure.
Yeah, no doubt. I mean, I think that summed it up perfectly is, hey, when all is good, everything's good, right? Like, let's be honest. You could write an unsecured loan to somebody and give them whatever you wanted, and maybe you get paid back. But we're not in the business of like could or maybes. Like we want to make sure we're as protected as possible. So the underlying collateral is our backstop, right? What's not, that's the most important thing. We didn't even get into character, credit capacity, and all that other stuff. We're just talking about, hey, at the very least, if something completely awful happens, like you still have this collateral that you can go after and you can collect and you can make sure you recoup all your investment. And that's the most important thing. So, make sure you guys follow that. It's super important. We didn't make that up. We're just, explaining our experiences as we learn them. Hope you guys enjoyed this episode of the Private Lenders Podcast, and we'll see you guys next week. Thanks again. We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.